Okay, so you're running a business, you need capital to grow, and you're probably thinking traditional loans, maybe equity financing. It feels like a bit of a maze sometimes, doesn't it?
It really can. Those are the usual suspects, definitely. But there's this other path gaining traction, especially if your sales are, pretty steady.
You're talking about revenue-based financing, RBF. We're hearing that term more and more.
Exactly, RBF. And companies like Ultimate Business Capital, they're becoming quite prominent in this space.
Right, so that's our mission for this deep dive. Let's try and cut through the jargon. Understand what RBF actually is, how it works day to day, and why providers like Ultimate Business Capital are worth knowing about.
Think of it as a shortcut to understanding this, well, pretty flexible funding option.
A very welcome shortcut for many, I imagine. Finding the right capital can feel like a huge blocker to scaling up.
No doubt about it.
Okay, let's get right to the heart of it then, this RBF concept. Fundamentally, it's like getting paid now for sales you expect to make later. Is that the gist?
That's a great way to put it, yeah. You get capital up front, but how you pay it back is directly linked to a percentage of your future revenue.
Okay, so that's the key difference then. Because a traditional loan has that fixed payment, right? Doesn't matter if you had a great month or a terrible one.
Precisely. That payment is due, regardless. And with equity financing, you're selling off a piece of your company permanently.
Which many founders are, understandably, hesitant to do. So with RBF, and specifically looking at how Ultimate Business Capital does it, the repayment actually adjusts.
It adapts, yes.
Yeah.
That's the core principle. Should we walk through how that process looks, maybe using Ultimate Business Capital as the example?
Yeah, let's do that, step by step. So first, a business needs money, right?
Right.
For expansion. New product, marketing push.
The usual growth drivers.
Right.
Could be anything, really, that requires investment to scale. So, step one, identify the need.
Okay.
Step two, they connect with a provider like Ultimate Business Capital. They express interest in RBF. Then, Ultimate Business Capital digs into the numbers. They're looking closely at the business's sales history. What they want to see is consistency, predictability in revenue.
So it's really data-driven. Less about assets, maybe, more about the income stream.
Exactly. Things like monthly recurring revenue for a SaaS business or repeat purchase rates for e-commerce.
Okay.
That kind of data is crucial because remember, their repayment comes directly from that revenue.
Right, okay. So if the sales history looks good.
If it looks solid, they move to defining the terms. And there are a few key parts to this agreement with Ultimate Business Capital.
Okay, what are they?
First, the upfront capital amount.
Yeah.
How much money the business actually gets.
Got it.
Second, the revenue share percentage, sometimes called a royalty rate. This is the agreed-upon percentage of future revenue that goes back to Ultimate Business Capital each period.
Like a small slice of each sale, basically.
Sort of, yeah. A slice of the total revenue for that period. And third, the total repayment cap. This is super important. It's the maximum amount the business will ever repay.
Oh, okay. So it's not open-ended. There's a limit.
Correct. It's typically the initial capital plus a multiplier, maybe like 1.2 times, maybe up to 2 times the original amount, depending on the risk assessment.
Okay, so there's some predictability in the total cost. What happens once those terms are agreed?
Agreement signed, Ultimate Business Capital sends the funds. The business gets the capital.
And then the repayments start.
Yes,
Okay.
usually monthly.
Yeah.
The business shares that agreed upon percentage of their revenue with Ultimate Business Capital. And here's the really interesting part, the flexibility you mentioned.
Right.
If the business has a fantastic sales month, that percentage means a higher repayment amount. So they pay back Ultimate Business Capital faster, potentially hitting that repayment cap sooner.
So success means you clear the obligation quicker. What about a slow month? That's the worry with fixed loans.
And that's the beauty of RBF. If sales dip, that same percentage results in a lower repayment amount to Ultimate Business Capital. It automatically adjusts down.
Okay. So it eases the pressure when cash flow might be tighter.
Exactly. It's designed to align with the natural cycles of the business, providing a kind of buffer during those leaner periods. It's much more, organic compared to a fixed payment looming over you.
That sounds incredibly useful for managing cash flow, especially for businesses with seasonal or fluctuating income.
It really is. And this continues month-by-month payments based on revenue until that total repayment cap agreed with Ultimate Business Capital is hit.
And once the cap is reached,
It's done. The agreement concludes. The business owes nothing further. They keep all subsequent revenue.
okay, that flexible repayment is definitely a huge plus. What other advantages stand out with RBF, thinking about providers like Ultimate Business Capital?
Well, another major one we touched on, it's non-dilutive. You don't sell shares. You don't give up ownership or control.
That's massive for founders, keeping control, keeping the upside.
Absolutely. It's often a primary motivator for choosing RBF.
Oh,
Also, the process itself. Getting RBF through someone like Ultimate Business Capital can often be faster.
faster than traditional bank loans or, say, a venture capital round.
Generally, yes, because their main focus is that revenue stream data, the assessment and approval can be more streamlined. Less paperwork, perhaps, fewer hoops to jump through compared to traditional underwriting.
So, quicker access to funds when an opportunity arises. That makes sense.
And tied into that focus on revenue, Ultimate Business Capital might not require the same kind of hard assets as collateral that a bank often needs.
Oh, interesting. So, it could be better for businesses that don't have lots of physical equipment or property, like software companies.
Precisely. Software as a service, many service-based businesses, companies that are asset-light can find RBF particularly accessible because the lending decision hinges more on their performance and future potential, less on seizable assets.
That really opens it up then. It positions RBF and providers like Ultimate Business Capital as a really strong alternative, doesn't it? For businesses maybe not quite right for a bank loan or those who just don't want to go the VC route.
Exactly. It fills a really important gap in the funding landscape.
Yeah.
And it's not just a niche thing anymore.
Yeah, it feels like the conversation around it is growing. Is the demand actually increasing?
Oh, definitely.
Oh.
Market projections show pretty significant growth for the whole revenue-based financing sector over the next few years.
Really?
Yes. It strongly suggests more businesses are seeing the benefits, finding RBF attractive. They see providers like Ultimate Business Capital as a way to fuel growth without those traditional strings attached.
So, wrapping things up a bit, this deep dive into RBF, looking specifically at how a provider like Ultimate Business Capital operates, it really highlights it's just a fundamentally different way to get funded.
It is. And the key takeaway, I think, is that the repayment rhythm matches the business's own pulse. It's designed to work with the ups and downs, not against them.
So hopefully for you, our listener, the whole world of business financing feels a little less like that maze we mentioned at the start. We've unpacked RBF, looked at how companies like Ultimate Business Capital make it work. It's a compelling alternative.
And that leads to maybe a final thought to chew on. Given that flexibility, given that you keep full ownership, how could this type of funding change how you think about growing your business? Could moving beyond just loans and equity actually unlock a different, maybe even better path forward for you?